First batch of chicken imports from the United States is expected in the country in March after the two countries agreed to keep the deal between them going. Angelo Coppola reports that the U.S. has taken a renewed interest in Africa as it engages in trade agreements globally. Now, joining me to delve further into this issue is Daniel Ringes in Washington. Daniel, welcome to the show. Now, the IMF has made it pretty clear that it is ready to help African exporters, oil exporters, during these tough times. But countries like Nigeria and Angola seem to favor the World Bank and, of course, the AfDB right now. Now, why do you think this is happening? Could it be political?
Well, I think that in the case of Nigeria, certainly the Nigerian economy faces challenges from the low commodity prices. But on the other hand, it is a much more diversified economy than, say, Angola. So I think the World Bank and the IMF both have in their mind that what Nigeria needs to do in order to maintain the strength of its overall fiscal situation is to look at how it brings in new revenue from taxes, potentially borrows a little bit, and also looks at where it can make spending cuts in order to meet its own objectives and also to manage the crisis of commodities. So given the specific situation with the Nigerians at the moment, some of the assistance that can be provided at the moment probably is more appropriate to the World Bank, and the need to continue to invest in infrastructure, transport, etc., in order to keep the economy on track and diversify the economy, rather than any major balance of payments crisis that Nigeria doesn't seem to face at the moment, given the fact that it has these diverse sources of growth overall in its economy.
Now, Daniel, with the growing strength of African institutions like the AfDB, the Afrexim Bank, and of course new players like the Asian Infrastructure Investment Bank and the BRICS Bank, could African countries become more oblivious to institutions like the IMF?
Well, I think it's going to be a more competitive environment, particularly for lending on infrastructure. And once the current commodity crisis and the turbulence on global markets and the concern of market traders and the general public begins to wane, and we start to see that many parts of Africa still are very sustainable, I think then people will realize that there are very good reasons to continue to invest in Africa. And those sources of infrastructure, spending and investment will come from many different places. And I think the World Bank is minded to that. They understand that dynamic. They are in some cases, including with the Asian Infrastructure Bank, willing to work with them to maintain high lending standards. But that does create a competitive environment. But at the moment, I don't see any viable alternative to the IMF. The IMF's job, basically, is to backstop the entire economy when it comes to balance of payments. I think that role will continue. So it's a sort of lender, not necessarily of last resort, but certainly one that can provide the most security in terms of the confidence of investors and the ability of any country that is in crisis to manage that crisis for the longer term.
Well, thank you, Daniel, so much for those insights. Of course, he's joining us from Washington. Now, to reiterate an earlier story, the first batch of chicken imports from the United States is expected in South Africa in March after the two countries agreed to keep the deal between them going. Now, Angelo Coppola reports that the U.S. has taken a renewed interest in Africa as it engages in trade agreements globally.
The U.S. is on a drive to develop and sign trade relationships. Its trade representatives are here now in talks, and the message is simple. We are flexible and looking to enter mutually beneficial agreements. What form these will take depends on each country's requirements and what's on offer.
Should we be negotiating free trade agreements with Africa? What is the architecture for that? We are looking at, are there other things we could do? Some people are saying bilateral investment treaties. Some people are saying double taxation treaties. Some people are saying give tax credits to U.S. businesses that invest in Africa.
However, a word of caution was issued to other African countries looking to enter AGOA-type relationships.
So we're doing it with China in a particular way, and we're trying to do it with the US in another way. The real disadvantage of a gift, which is what AGOA is that if you make as a business investment decisions on a gift which can be withdrawn, is that investment or is that gambling? And that's the difficulty that all African countries that benefit and all industries in those countries have to think, can we gamble with our owners' money when we're not sure what the US will do next?
While this will remain a challenge, perhaps it's time for a different approach to bilateral agreements. There are several trade blocs on the continent, and they could be working together to negotiate with large economic powerhouses.
If these countries negotiate as a regional grouping, we have SADC, EAC, ECOWAS, COMESA, if they negotiate even within the tripartite free trade area, they'll certainly have more leverage to negotiate a beneficial deal for themselves.
The US also appears to be re-evaluating its approach to the continent.
Would we be looking at something that could be done in a broader context? We don't know. I'm not saying we would negotiate with the CFTA, but I think that we're looking at all of that and thinking about what's the best way to really enhance and develop and diversify the US-Africa trade and investment relationship.
With less than 6 weeks to go before that first shipment of poultry comes into South Africa, it's almost a fait accompli that it's going to happen. What this means for future trade agreements and arrangements between the US and African countries remains to be seen, but it looks like the future is starting to brighten up. I'm Angelo Coppola for CCTV in Johannesburg.